Two people, same age, same income, same discipline, both putting $500 a month away for retirement. One of them will have a $1 million account at 65. The other will also have a $1 million account at 65. But those $2 million accounts won't be worth the same amount. That gap between what your statement says and what you actually walk away with is the thing nobody explains clearly when they tell you to open a 401k or a Roth IRA. And depending on which account you're sitting in right now, it could change the amount of money you actually get to spend in retirement. Hey, I'm Larry, a semi-retired electrician who's figured out simple money systems that actually work. And stick around until the end. I've got a free gift to help you figure out which path fits your situation. I've spent decades listening to people argue about this exact question. 401k or Roth IRA, pre-tax or post-tax? Which one wins? And almost every argument I heard was missing the same piece. Nobody is taking into account what you actually walk away with. By the end of this video, you'll know exactly which one comes out ahead after taxes, and why the answer is more nuanced than anyone on the internet wants to admit. Let's get into it. Ryan and Sarah are both 30 years old. Both earn $65,000 a year, and both of them just made a decision they're going to live with for the next 35 years. Ryan opened a Roth IRA. He puts in $500 a month, and it comes straight out of his take-home pay after taxes. No employer match, no current tax break. He simply pays his $500. It goes in, and that's the deal. Sarah enrolled in her company's 401k. She also puts in $500 a month from her paycheck. But here's where it gets interesting. That $500 goes in before the IRS takes their cut. Sarah earns $65,000 a year and sits in the 22% tax bracket. Normally, if she earned $500 and tried to save it, the government would take $110 first, and she'd only have $390 left to invest. The 401k skips that step entirely. The full $500 goes straight in, and the tax bill gets deferred until later. So, her $500 contribution only costs her $390 out of pocket. That's the first advantage. The second advantage is the employer match, and this one is pure free money. Sarah's company matches 50% of her contributions, but only up to 6% of her salary. And that limit matters. It has nothing to do with how much Sarah puts in each month. It's based entirely on her $65,000 salary. 6% of $65,000 is $3,900 a year. Her employer pays 50% of that, $1,950 a year, which works out to approximately $162 every month going into her account. It's money she didn't earn, money she'll never pay tax on going in, and it's all hers, just for showing up and enrolling. So on day one, Sarah has $662 going into her retirement account every month. Her out-of-pocket cost is $390. Ryan has $500 going in, and his out-of-pocket cost is $500. Sarah looks like she's playing a completely different game. Ryan looks like he chose the harder path. So the question is, did Ryan make a mistake? They both think they made the smart call, and they're both committed to their plan. But the next 35 years will tell us which one was right. For the first few years, Ryan's Roth IRA is pretty quiet. There's no tax break arriving in his paycheck, no employer match closing the gap. It's just the $500 a month going in and compounding at a 7% average annual return. By age 35, Ryan has about $36,000, and by age 40, he's at $87,000. His account is climbing steadily. And what doesn't show up on any statement is the structure. Every single dollar in Ryan's Roth IRA has already been taxed, and that's an important distinction. The IRS already got their cut. Whatever grows from here, every gain, every dividend, every year of compounding, the government has no claim on any of it. Ryan's statement balance and his real balance are the same number. There's no asterisk. One thing worth noting before we go further. Sarah's $500 contribution only costs her $390 out of pocket because of the tax deduction. And that extra $110 a month could be invested separately, but let's set it aside for now, because we're comparing the accounts themselves. We'll come back to it later, and you'll see why it matters. Now back to Ryan. He also has a flexibility advantage that most people overlook. Roth IRA contributions can be withdrawn at any time, with zero taxes and zero penalties. Not the earnings, just the money he put in. So if a genuine emergency hits, he can access what he contributed without a penalty. Whereas a 401k would cost him income tax, plus a 10% early withdrawal fee on the same money. That's not a small difference. Another decade has passed, and Ryan is now age 50. His balance is $262,000, and every dollar of it is entirely his. But is it worth more than it looks? Now let's look at Sarah. Her first year feels good, really good. Her $500 contribution only costs her $390 out of pocket, and the employer match arrives like clockwork. Sarah's getting more money in at a lower personal cost with free money on top. It's hard to argue with that. And by age 35, Sarah has $47,000. By age 40, she's at $115,000. The lead over Ryan is real, and it's growing steadily every year. But what Sarah doesn't see is what's sitting inside that balance. Every dollar Sarah contributed went in pre-tax. Every dollar her employer matched went in pre-tax. And every dollar of growth on both of those is pre-tax. The IRS hasn't touched any of it. And not because it's tax-free, but because it's tax-deferred. The bill still exists, it just hasn't arrived yet. At age 50, Sarah's 401k hits $347,000. And on paper, she's crushing it. But the big question is, since it's pre-tax, how much of that actually belongs to her? With her account sitting at $347,000, and using our 22% tax assumption, her real after-tax value is closer to $270,000. In comparison, the $262,000 in Ryan's Roth IRA has already been taxed. The gap that looked like $85,000 is actually about $8,000 in real after-tax terms. But then Sarah gets promoted. Her income grows the way she hoped it would. And here's where the 401k structure deserves a harder look. She deferred taxes at 22% when she was 30. But if future tax rates rise, and given national debt levels, that's a real possibility, or if Sarah builds substantial retirement income from multiple sources, her withdrawals could be taxed at higher rates than she expected. The bet you're making with a 401k is that your future tax situation will be manageable. For many people, that bet pays off. For some, it doesn't. Sarah did everything right. She took the match, she contributed consistently, but she doesn't get to see her final score until she starts withdrawing. Here's the scoreboard for Ryan and Sarah at 65 years of age. After 35 years of contributing $500 a month, Sarah's 401k is worth just over $1.2 million. Her employer contributed roughly $68,000 in matching funds over the years, and the market compounded everything at an average return of 7%. On paper, Sarah is a 401k millionaire. Ryan's Roth IRA is worth about $906,000. No employer match, no upfront tax break, just his $500 a month compounding for 35 years. Sarah leads by nearly $300,000. Now, if you showed these two numbers to almost anyone, they'd say Sarah won, and they'd be right. But here's what the statement doesn't tell you. The tax bill. Sarah's 401k withdrawals are taxed as ordinary income, the same as a paycheck. If she withdraws $60,000 a year in retirement, her federal tax bill after the standard deduction is roughly $5,200. So her $60,000 withdrawal becomes about $54,800 in her pocket every year. If Ryan withdraws $60,000 a year in retirement from his Roth IRA, his federal tax is zero. He keeps the full $60,000 every year. That $5,200 annual gap adds up to roughly $130,000 in additional taxes over a 25-year retirement, taxes Ryan never pays. Using a simplified 22% effective tax assumption, Sarah's $1.2 million works out to roughly $937,000 after taxes. Ryan's $906,000 is exactly that. It's clean, no asterisk. Sarah still leads, but by roughly $31,000, not $300,000. And almost all of that remaining gap traces back to the employer match and 35 years of it compounding.
Now, remember that $110 a month Sarah was saving in taxes that we set aside earlier?
If she had invested that separately in a taxable brokerage account at the same 7% return, it would have grown to about $176,000 after capital gains tax over 35 years. And if you add that to her after-tax 401k value, Sarah's total picture actually comes out ahead of Ryan's by a meaningful amount. That's the honest answer. The 401k with the employer match and invested tax savings significantly beats the Roth IRA in total dollars. But only if Sarah actually invests that tax savings every month for 35 years.
There's one more piece Sarah didn't plan for. At age 73, required minimum distributions kick in. These are mandatory annual withdrawals based on her account balance, whether she needs the money or not. And by then, Sarah's 401k has continued growing, and her first required withdrawal is around $78,000. She owes income tax on every penny of it, and she doesn't control the timing. As for Ryan, his Roth IRA has no required minimum distributions, ever. He controls when he takes money out, how much he takes out, and what tax situation he's in when he does. If he doesn't need the money at 73, it sits there and keeps growing, and it can be passed to his kids entirely tax-free. Sarah's statement looked bigger every single year. Ryan's account was worth more per dollar every single year. So here's the real answer. I want to be straight with you, because the comments on every video about this topic show how much confusion exists. The 401k with the employer match is genuinely powerful. Nobody who captured a full employer match and contributed consistently for 35 years made a bad decision. The question isn't which account wins on paper. It's which account fits your situation. If you're early in your career and in a lower tax bracket, the Roth IRA is almost always the right first move. You're paying taxes at one of the lowest rates you may ever pay. Every dollar of growth from here is permanently tax-free. You keep complete flexibility and complete control over when you access it. If your employer offers a match, capture it first, always. A 50% guaranteed return on day one is the highest value move in personal finance. Nothing else is close. Walking away from an employer match to prioritize a Roth is one of the most expensive mistakes a saver can make. If you've maxed the match and have more to save, that's when the Roth IRA becomes your next best move. And if you're in a high tax bracket right now and genuinely expect a lower one in retirement, the traditional 401k math can work in your favor. But be honest with yourself about that assumption. Most people underestimate how much wealth they'll actually build and overestimate how much lower their tax rate will be in retirement. Here's one thing you can do this week. Log into your HR portal and check whether you're capturing your full employer match. If you're not, that's the first thing to fix. Everything else comes after. And that's the real Larry's ladder lesson here. The account with the bigger number on the statement isn't always the account with more money in your pocket. Know what you're actually choosing between before you choose. And here's what I want you to take away from this. In a world where nobody can predict future tax rates, where careers and income paths are shifting in ways none of us fully planned for,
Having control over your own tax situation in retirement isn't a luxury. It's a strategy. The best financial decision is always the informed one. And now, you have the information. If this helped you think through this decision, hit subscribe. I break down real financial scenarios like this every week. And drop a comment below. Which path would you choose, and why? I actually read every comment. And check the description for your free gift. It's the 401k versus Roth IRA decision guide I built for this video to help you figure out which path fits your situation. No strings attached. And if you want to go deeper on how your investment account choice stacks up against a regular brokerage account, watch this video next. And remember, if this electrician can do it, so can you.